Hi, thanks for joining me today. I thought after the market sell-off this week that I would spend just a few minutes talking with you about what is going on in the economy and what economists are saying about the potential for recession now in the US. We saw some terrible economic numbers that came out in the first quarter, and the media has been all over the potential for future decline. So I thought I would just discuss with you a little bit about what the economists are actually saying and add some context to what you've been seeing. So if you have questions about recession, if you'll spend 10 or so minutes with me, I'll try to clarify some of the issues that are going on right now. First thing is just our standard disclosures. And the next thing is the market performance. So as you can see, over the last few weeks, we've seen a bit of a sell-off, and the last week was pretty hairy. In fact, so hairy that we ended up below where we were in early March. We saw the market drop to about negative 12.5 in March. And as you know, we did some trading during that time frame. Now the market is down to negative 13.3. And so we're seeing quite a lot more decline just in the last couple of weeks, and particularly this week. In fact, as you get the headlines from the news, you can see here we are at the end of April, and the Wall Street Journal reports that the tech rout has dragged the NASDAQ to the worst month since 2008. Of course, comparing to 2008 is not the best comparison, as you can probably guess. We've talked about valuations being high in that growth sector, and it turns out that unfortunately we're having to pay some of that back right now as confidence in the U.S. has waned. And so we saw a significant decline in the U.S. market, the S&P 500, the NASDAQ, and other global markets as well. So what's going on exactly? How are things being impacted across the world, and what should we anticipate? I'm going to try to answer three questions for you right now. Those three questions are very basic, and I think they're questions on everyone's minds. Right now, how is the Ukraine conflict impacting the markets? Should we expect a recession and high inflation sometime in the near term? And what is the outlook for the U.S. economy? So I'll touch on each of these three questions, and I'm going to go very quickly, but feel free to reach out if you'd like further clarification on any of these specific questions. The first thing I'll address is, how is the Ukraine conflict impacting the markets? I think, first of all, you have to know that there are two sides of it. There is the economic impact, and there is the psychological impact. There is a significant psychological impact. I think the Ukrainian conflict is on everyone's mind, and it doesn't help when you see things like news stories from CNN saying that NATO has been scrambling jets to intervene with the Russian jets, and that you're seeing the news stories about all the atrocities in Ukraine and the people who have died there, and the aid that's required, and that the U.S. is sending aid. Of course, there's a psychological impact of that. I want to talk more specifically, however, about the financial impact, and to share with you just a few perspectives. The first one is from Bloomberg that was published in early March, not too long after the invasion. And actually, they responded by saying, if you see where the arrow is, the immediate reaction to dangerous mass conflicts like the war in Ukraine tend to not affect equity valuations over the long term. What drives equity prices are increased corporate revenue and profit, and the typical geopolitical event isn't big enough to change those very much. Actually, in this case, we are seeing some changes because this particular geopolitical event has had a direct impact on energy prices and food prices all around the world. And so as a result, we've seen a spike in inflation, which of course has at least an ancillary impact on those parts of the market, and it pulls money away from other types of companies. So as a result, we see declines in revenues on companies as people redirect their spending to food and energy. The next one is also from the Wall Street Journal, was published in early March. And the Wall Street Journal says a range of U.S. data suggests U.S. economic activity has been picking up. The economic expansion appears to be on solid ground, and the impact of the Russian invasion, the U.S. economy, on the U.S. economy will be in the margins. And so here we are again, kind of separating what is the psychological impact versus the economic impact. And I think we would all agree that there is at least an ancillary economic impact, but I'll show you in a few moments how mostly the economic impact in the US is limited. What's happening is we're seeing a shift in sentiment, and we're also seeing a shift in inflation rates, which should change as the year progresses and as things progress with the conflict there, and hopefully come to some resolution in the near term. So the next thing that I'll discuss with you specifically is whether or not we should expect a recession in the near term. And by near term, I mean 12 to 24 months. And then the next question is about inflation. Inflation has been on everyone's minds, of course, because every time you go to the gas pump, every time you go to the grocery store now, you're seeing higher prices all throughout the US economy. And this is as the result, in large part, to what's happening in Ukraine. But there are in general inflationary pressures all around the US. And in fact, you're seeing that abundantly in the media right now. The most recent Economist that was published, I received it just yesterday. I guess it was the April 23rd, 22nd version of the Economist. And it said, has the Fed failed us? You know, has the Fed failed us? And essentially the articles that are accompanying the headline are about the Fed reacting too slowly. So the Federal Reserve began raising rates. They began cutting back on the quantitative easing and actually doing some quantitative tightening soon. And so what's happened is the Fed has intervened, but the writers of the Economist believe that the Fed has intervened too slowly. And so they've let inflation get ahead of them, and now they're playing catch up, and we'll have to raise rates aggressively. That was echoed by the Wall Street Journal, where they quoted three former Fed officials who said the same thing, that recession is almost inevitable at this point, for the simple reason that the Fed will have to raise interest rates aggressively to put a hold on the inflation rates that we're seeing now. And so what does that mean exactly? You've probably seen the price increases at the store, but the inflation rates that we've seen have blown through the averages recently. As you probably know, when we saw the inflation rates in January and February, they increased significantly, but then we had a peak in March when it increased to 8.5%. In January, it was 7.5%, February 7.9%. So the headline inflation, which includes energy and food, shot up dramatically just in the last few months. And so the question then becomes, what's happening with that inflation rate and how is that impacting the economy? Well, the inflation rate is as a result of a number of factors. The first thing is we had an enormous amount of federal stimulus, which provided spending power to many people in the US economy. That collided then earlier this year with supply chain disruptions exacerbated by what's happening in China with their COVID response and what's happening in Russia and the sanctions that have been applied there. So once we have a lot of supply chain disruptions that run into the extra demand in the consumer side of it, we always see inflation. Now, one thing that you have to understand is that in the US, a large part of the inflation increases were attributed to food and energy and not core inflation. Food and energy amount to a smaller and smaller component of US consumption. And the graph on the left just demonstrates what that means exactly. If you look at the bottom line, that's the energy consumption of the average US consumer. And it has dropped from well above 5%, close to 7% about 50 years ago, to now 4.3%, a much smaller percentage of total consumption for US consumers. And when you combine food and energy, back in 1959, it was nearly 27% of the average household consumption, and now it only counts for about 12% on average. That's because the households are wealthier and the prices of food and energy are a smaller percentage of their total spending. So as a result, those inflation increases don't help, but they certainly don't hurt the US economy in the way that they have in years past. The other factor that we have improved on over the similar time frame since 1967 is that energy independence component. And if you look on the graph on the right, as you can guess, we are importing less and less oil. And now, December 2021, the net imports as share of GDP was 0.0. In other words, we're producing as much oil as we are importing. And so what that does then, when oil prices go up, of course, those producers benefit, and those producers are in the US. That actually just contributes to the US economy and counterbalances what's going on in the US economy. So inflation as a factor, when we consider that the rise in inflation most recently has been attributable primarily to food and energy. Food and energy are a smaller component of the US economy. So on a global perspective, the food and energy are having less impact on the US economy. On a household by household basis, it depends on how wealthy you are. The poorer communities are impacted greater because it's a greater percentage of the total. But in general, the US economy is not significantly impacted by that. However, we are seeing an increase in GDP growth that has also kind of contributed to this consumption surge. And what has happened is, as you can probably guess, the Fed stimulus has put a lot of money into pockets that has been spent in the US economy, and we end up with this V-shaped recovery that we saw after the recession. Now, as you probably know, a large part, we think, of the market sell-off recently was as the result of the reported decline in GDP growth in the first quarter. So most recently, we saw a report that GDP contracted by 1.4%. Well, of course, a contraction of GDP is the first sign of recession. In fact, that's how it's defined. Recession is defined as 2 consecutive quarters of GDP contraction. And we saw one quarter in the first quarter of the US, and it has been all over the news, as you can probably attest to. But there is a mitigating factor that they are not reporting, and that is that a large part of the contraction in the first quarter of 2022 was as a result of spending in the last quarter of 2021. And you say, well, what do you mean by that, Scott? Well, the way that they measure GDP, they include spending, but they also include inventories. And so in the last quarter of 2021, we saw a record increase of $193 billion real increase in inventories across the US. Now, what that did was that increased the modest growth that we would have otherwise expected to see of about 1.4% in 2021 at the end of the year. It increased that to 6.9%. So buying the extra inventory contributed to that GDP growth at the end of 2021. Well, of course, companies coming into 2022 are not going to continue to buy the inventory. That was a year-end event. And so the inventory, as it's reduced in early 2022, the excess inventory from 2021 is a detractor from GDP growth. So while we saw a negative 1.4% in the first quarter of 2022, much of that was attributable to what happened in the fourth quarter of 2021, and it's just a shell game of math. And so what we would expect to see is that for the remainder of the year, we expect to see growth in the US, and all the economists that we subscribe to right now are expecting to see the economy to continue to grow in the US throughout the rest of the year. So the knee-jerk reaction of the market to GDP contraction is frankly just a misunderstanding of how the math is calculated, and it's a knee-jerk reaction to bad news. So we think it's a little bit overreaction because frankly, we think that the economy is in pretty healthy condition and we would expect it to continue to grow. So is recession imminent? Well, we would say that there is a higher probability of recession in the next 24-month period, but the underlying message is that there is still a pretty healthy economy there, and I'll show you in a moment exactly what I mean by that. And then as far as inflation is concerned, because we still have a healthy consumer demand, and because it's going to take some time for the supply chain interruptions to work themselves out, we also expect a decline in inflation, but it may be a little bit persistently high throughout 2022 as it declines to the end of the year, maybe not as fast as we thought it might initially because of China, because of Russia, but we'll see those inflation rates begin to decline. We may not have seen the peak yet, And I'll just warn you about that. We may see higher inflation rate numbers in the next month or two, but within the short period of time, a relatively short period of time, we would expect those numbers to come down. They've come down in terms of things like used car prices, as an example, and other parts of the economy. So as they do that, we'll see that reflected in the headline core inflation numbers. So the last thing I'll share with you is what's going on in the US economy and how things are progressing. First thing is that I will tell you that we still are sitting on a ton of cash. And so the cash that we have in the money supply right now is an astounding amount. The question that often comes up is, well, isn't that cash already in the system now? Hasn't that been spent? Well, you can see from the bottom graph here, the CARE stimulus that we saw as a result of the economy has turned over a little bit, meaning that some of that cash has been spent, but not all. And so as a result, a lot of that is still sitting on the sidelines, and we're starting to see increases in airline prices, in cruise prices, and hotel occupancies, et cetera, because a lot of people are ready to start traveling and they're spending some of that money as they travel. That's an economic stimulus for the US. We'll start to see the prices go up a little bit, but we'll also start to see those earnings go up for many of those companies. So that's a positive for the US economy. And then one more thing I'll share with you about the US stock market. As I mentioned before, the sentiment in the US has turned pretty significantly negative. It's a combination of the news cycle, sharing what's going on at the Fed level, inflation rates going up, and also what's happening in Ukraine. So over the last couple of months, we've seen a pretty significant decline in consumer sentiment. What's interesting about that, however, is that once consumer sentiment hits a certain level, we start to see increased probability that the market will recover quickly. And so if you look over the historical examples of this decline in consumer sentiment, you can see in these various periods, even when we're not in recession, the market tends to recover quickly after these periods of decline. So going back to 2003, you can see after this decline in consumer sentiment, the market peaked out up 32%. After 2005, it was up 14%. In November of 2008, when sentiment dropped to its lowest level, after that, it peaked at 22%. Same thing here for August 11. We saw a 15% increase. So essentially what that does is that it builds in potential for the market to recover, because the sentiment tends to be reflected in the market and not necessarily the stock valuations. So we've seen valuations come down and the potential in the market has been going up as a result. It's obvious in this graph that we're at one of the lowest levels we've seen since 1971. So as a result of that, we think that the pent-up opportunity continues to increase as the sentiment declines. The last thing I'll share with you is one tidbit of really good news, and that is the leading economic indicators for the US economy. So the leading economic indicators is just a compilation of indicators that suggest what might happen in the US economy in the near future. The first thing the Conference Board does is they gather all this data and they publish it, and as long as it's increasing, the potential for the economy to grow is there. Whenever it turns over, or as you see here, there's a hump in the leading economic indicators, that means that we may see a recession in the near future. Well, fortunately, we're seeing the leading economic indicators continue to rise. We've not seen it roll over. There's a little bit of a hiccup right here at the very end, but we've not seen that very obvious rollover. So if there is a recession on the horizon, it's not showing up in the leading economic indicators. As the Fed raises interest rates, as they become more and more aggressive, the soft landing of no recession becomes less and less likely. But as the leading economic indicators will show us, it will give us a feeling as to whether or not the recession will be deep or if it'll be brief. And at the moment, it looks like things look pretty positive right now. So they may be able to balance those increases with a more steady settling of the US economy and lowering inflation rates. So thank you very much for spending just this time with me. I hope this has given you a little bit to work with about the economy. There are a lot of things going on, but mostly the news cycle heads it in one direction. There's always a balanced story, and I hope this has been helpful for you to see. So please let us know if you have any questions about anything that's going on. We're happy to help you and happy to share with you anything that we can with regards to the economy or the markets, and look forward to talking with you again soon.